All right, welcome CIMA E1 students. Today we're tackling a relationship that can literally make or break a company, and that's the link between marketing and finance. I want you to think about it like this. Marketing, they're the engine, the powerhouse, driving all the revenue. But you, my friend, you're the finance expert, the engineer. Your job is to make sure that engine is running profitably and doesn't just burn through all its fuel. If you can master this partnership, you're not just set for your E1 exam, you're ready to create some serious, sustainable value in any company you walk into. So in this explainer, we're going to give you the exact framework you need to become that absolutely essential strategic partner. So let's talk about the classic standoff, right? You've probably seen it. The marketing team bursts in. They're buzzing with creative ideas. They're all about growth, brand, and grabbing market share. And then in walks finance, the guardian of the cash, asking the tough questions about budgets, ROI, and, risk. It's a natural tension for sure. They want to spend money to make money, and you need to make sure every single pound spent is a smart investment. Our goal today is to completely tear down that foes mentality and show you exactly how to build a powerful friends synergy that will push the whole business forward. And here's our game plan. We'll kick things off by getting a solid grip on marketing's world. Then we'll look at the environment they operate in and the tools they use. From there, it's all about specific sales and targeting techniques. Then we'll hit the really juicy stuff, product strategy and costing, where finance and marketing truly meet. We'll cover the huge impact of big data, and then we'll wrap it all up by looking at how you partner up and measure success with KPIs. This structure is going to give you a rock-solid foundation for your E1 exam. Okay, let's dive right in. Part 1, the role of marketing. Look, to be a great finance partner, you have to understand the other side. You've got to walk a mile in their shoes, speak their language. So let's break down the core concepts that drive every single marketing decision they make. First up, you have to know the difference between strategic and tactical marketing. Strategic is the big picture, right? The long game. It's answering the huge questions like, where are we even going to play and how are we going to win? Tactical marketing is the here and now. It's the stuff you see every day. The social media campaigns, the email blasts, the 20% off discount for this weekend. Now, where do you fit in? Well, you're involved in both. You challenge that strategic vision with tough financial questions like, do we actually have the capital for this 5-year plan? And for the tactical stuff, you're the one holding them accountable, asking, did that promotion actually deliver a positive return on investment? Now, it's super important to remember that not all markets are the same. You've got B2C, where you're selling to individual consumers, and B2B, selling to other businesses. And the financial implications? They're totally different. B2C often means tons of small transactions, so your financial models will be all about statistical forecasting. But in B2B, whoa, you might have just a handful of huge clients that make up most of your revenue. All of a sudden, your job becomes less about forecasting and way more about strict credit control and managing concentration risk. Because if just one of those big B2B clients pays late, it could seriously mess with your cash flow. This table is fantastic because it shows how a company's whole philosophy dictates its actions. A production-oriented company is obsessed with being efficient and cheap. For finance, the big worry there is the cost of holding a mountain of unsold inventory. A sales-oriented company just wants to push whatever it's made, leading to high selling costs and maybe even damaging the brand. A product-oriented company is all about having the coolest new features, which means you in finance are signing off on massive R&D bills, just hoping someone actually wants to buy the thing. So here's the key takeaway. The marketing orientation, the one that starts and ends with what the customer actually needs, is the one that's most aligned with creating long-term sustainable value. And that, my friends, is the ultimate goal of finance. Last up in this section, let's talk push versus pull. A push strategy is all about incentivizing retailers, think trade discounts, to stock your product and push it onto consumers. From a finance perspective, you're focused on managing that trade spend and analyzing your margins. A pull strategy, on the other hand, is all about building a massive brand that creates so much consumer demand that it pulls the product through the stores. Think about Apple's legendary campaigns. Here, the financial focus is totally different. You're dealing with huge advertising budgets and trying to measure the long-term, often fuzzy, value of brand equity. Your job is to help market prove that that massive ad spend is worth it with more than just vague ideas about brand awareness. So we've got a handle on the marketing mindset. Now let's move on to part 2, the marketing environment and marketing mix. This is all about looking at the outside world and the tools marketers use to deal with it. And for us in finance, trust me, every single one of these tools has a direct line to our financial models. Okay, so marketers can't just operate in a vacuum, right? They are constantly scanning the outside world using the Pestel framework. A political change could mean new tariffs. Economic factors like inflation can totally squeeze consumer spending. Social trends can make a product go viral or become obsolete overnight. As a finance pro, your job isn't just to be aware of a new trade tariff. It's to model its exact impact on your gross margin and then challenge the marketing team's sales forecast with that hard data. Pestel isn't just some marketing exercise, it's a vital input for solid financial planning.
Now, if Pestel is about looking outward, SWOT analysis is about looking inward. Opportunities and threats come from the outside world, but strengths and weaknesses, those are internal, and that's where finance has a huge say. Our healthy balance sheet, that's a major strength. Our clunky old IT system, that's a massive weakness. Once that big picture is clear, marketers reach for their toolkit, the marketing mix, or the 7 Ps. Just think of these as the levers they can pull. They can tweak the product, change the price, alter the place it's sold, or crank up the promotion. And for services, you add people, processes, and physical evidence. Now here's the kicker for you. Every single P has a direct impact on the P&L. Your job is to quantify the financial fallout of pulling each and every one of those levers.
All right, we've done our analysis. Now it's time to get into the action. In part 3, we're going to explore the nitty-gritty techniques that marketers use to really understand, target, and capture the market. This is where the big investment decisions get made. You know, every smart marketing move starts with data from market research. Quantitative research gives us the hard numbers, the what. Qualitative research gives us the why behind those numbers, the feelings and opinions. And guess what? This data is pure gold for your sales forecasting models. But here's the thing. Marketers don't see the market as just one big blob. They use this data for segmentation, slicing and dicing it into smaller groups based on things like where they live, their lifestyle, or how they shop. The whole point is to find the most attractive segments. And who helps define attractive? You do. By analyzing the potential profit from each segment, you help guide the marketing spend to where it's going to generate the absolute highest return. So once you've sliced up the market, you gotta pick your targets. And this right here is a classic risk versus return decision. You could go for mass marketing, one product for everyone. It's efficient, but boy, is it risky if tastes change. Or you could try differentiated marketing, creating different products for different segments. This has a much higher potential return, but it also comes with way higher costs. Then there's concentrated or niche marketing, where you put all your eggs in one basket and focus on just one tiny segment. As the finance business partner, your job is to model the costs, the potential returns, and the risk profile for each of these strategies so the company can make a smart, data-driven investment decision. So how do companies actually plan for growth? Well, the Ansoff Matrix is a fundamental tool that shows 4 basic paths. You can try to sell more of your existing stuff to your existing customers. That's market penetration. You can develop new products for those same customers. You can find totally new markets for your existing products. Or, the riskiest of them all, you can try to launch new products in new markets. That's diversification. Now, what's crucial here is that each of these boxes carries a wildly different level of risk and needs a different level of investment. Market penetration is pretty low risk. Diversification, extremely high risk. Your role isn't just to be aware of this, it's to be the gatekeeper. You build the business cases, you stress test the assumptions for each path, you secure the funding, and then you track performance like a hawk. This next section, this is where the magic happens. This is where the finance and marketing partnership really shines. We're talking about managing the entire product portfolio, understanding how products live and die, and the absolutely critical job of setting the right price. These are things you just can't do in separate rooms. When a company has a bunch of different products, how does it decide where to put its money? The Boston Consulting Group, or BCG Matrix, is a classic tool for figuring this out. It sorts products based on their market share and how fast their market is growing. Your stars are in high-growth markets and need tons of investment. Your cash cows are mature leaders that just generate cash, which you can then use to fund your stars. Question marks are the wild cards, the gambles. And dogs, well, those are the products you might need to get rid of. This matrix gives you and the marketing team a really clear, data-driven way to talk about where to put your resources. A classic exam topic, by the way. You know, products have a life cycle, just like people, and understanding these stages is so important for financial planning. At the start, in the introduction stage, your costs are sky high and you're probably losing money. Then comes growth, where sales take off and your profits hit their peak. After that, the shakeout begins as competitors flood in. In maturity, sales start to flatten out and the focus shifts to being super efficient with your costs. And finally, in decline, you have to make those tough calls about whether to keep the product around. Each of these stages has a totally different financial profile and needs a completely different strategy from the finance team.
And that brings us right to pricing, a true team sport. With full cost plus pricing, you make sure you cover all your costs, fixed and variable, by adding a nice markup. It's the safe, long-term approach. But then you have marginal cost plus pricing, which only looks at the extra variable costs of making just one more unit. This is brilliant for short-term decisions, like whether to accept a special one-off order at a lower price. As a finance professional, you don't just give them these numbers. You have to explain which method to use and when, so the business doesn't make a big strategic mistake based on short-term thinking.
Okay, let's switch gears and jump into the modern era. In part 5, we're diving into how big data has completely flipped marketing on its head. And for us in finance, this isn't just about cool new tech. It's about a massive shift towards more accurate, data-driven decisions.
Honestly, big data has been a total game changer. And for finance, it's amazing news. Let me tell you why. First, it lets marketers target their ads with incredible precision, which means less wasted money and a much higher ROI. Second, and this is music to our ears, analyzing huge amounts of historical data means we can forecast demand way more accurately. Third, it allows for personalization on a massive scale, which keeps customers happy and loyal. And finally, it lets us see the entire customer journey across all channels. The main takeaway here is that data turns marketing from a kind of subjective art form into an objective science. And that's a language finance speaks fluently. And that brings us to our final, and maybe the most important section: business partnering and KPIs. We've covered the strategy, the tools, and the data. Now, let's talk about how we actually measure success and work together day to day using the shared language of key performance indicators. Look, if you want to be a real business partner, you've got to track the metrics that actually drive the business. Check out these examples. Relative market share. That tells you about your long-term health and pricing power. Conversion rate. That's a direct measure of how efficient your marketing spend is. Revenue per user helps you understand the true value of your customers. Even something like click-through rate, which seems like a pure marketing metric, tells you if your ad spend is being effective. And upselling success, that links directly to increasing customer lifetime value, which is a critical metric for long-term financial health. We don't just report these numbers in finance, we help analyze them to find the insights that lead to better decisions. So, let's quickly recap our journey, shall we? We started by getting inside marketing's head, understanding their strategy, their tactics, their whole mindset. We looked at analytical frameworks like Pastel and the 7 Ps they use to navigate the world. We saw how research leads to smart segmentation, and how tools like the Ansoff and BCG matrices help guide where the money goes. And finally, we've seen how data and shared KPIs can completely demolish the walls between finance and marketing, creating the groundwork for a powerful, synergistic partnership that drives real, measurable value for the company. So let's bring it all home. The biggest takeaway for your CIMA E1 exam, and honestly for your whole career, is this. Your role is not to just be a number cruncher stuck in a back office. It's to be a strategic partner sitting at the main table. It's about understanding what drives the business, speaking the language of your marketing colleagues, and using your financial skills to help the entire organization win. The only question left is the one on the screen. Are you ready to partner for value creation? Thanks for tuning in, and all the best with your studies.